Welcome everyone to the Melbourne School of Government's Disruptive Ideas Seminar. It's really great to have you here today. I want to start by acknowledging the traditional owners of the land. I'm here upon Wurundjeri land of the Kulin Nations, and I want to acknowledge elders past and present, and also many of the emerging young leaders in this space who are still continuing the fight against colonialism. Today, I'm really excited to be joined by one of my colleagues, Nick, who's going to be talking about finance, technology, and regulation. And for those of you who are in this space, you would know that there's a lot happening in the regulatory space around finance and technology. And much of this stems from the 2007-2008 global financial crisis and then the 2010 flash crash. So we had lots of different regulations emerge from this space, but there's still a lot of things that have remained unexamined. And some of the things Nick's going to talk about today is the effects of regulation on financial activity, trading and the market in general, but also some of the limitations of regulation with respects to derivatives, algorithmic trading and neurofinance. So Nick did his PhD at the University of Melbourne, looking at practices of risks and organisation within emergency services and environmental management agencies in Victoria. And he's been a research fellow at the Melbourne School of Government with me, setting up the research program in regulation and design, looking at how we regulate emerging technologies, but also how we incorporate emerging technologies into our regulatory spaces. So I'm going to pass over to Nick. He will take you through this wonderful presentation, and then at the end, we'll have some time for questions. Over to you, Nick.
Okay, thank you very much, Tim, and thank you very much to everyone at the Melbourne School of Government for giving me the opportunity to deliver this seminar. Welcome, everybody. Okay, so I'm going to talk about finance, technology, and regulation today. But I'm going to start off with two kind of mission statements from regulators that you might be familiar with. One is the U.S. Securities and Exchange Commission. This is a kind of major player in the finance space, but similar things are being done or being said in Australia, namely at the Australian Securities and Investments Commission. So let's look at the kind of SEC statement. The mission of the SEC is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. The SEC strives to promote a market environment that is worthy of public trust. Okay, something similar happens in Australia. The Australian Securities and Investments Commission does the same. It's trying to promote a fair, strong, and efficient financial system for all Australians, and it has a number of kind of regulatory tools to do so. This doesn't seem very contentious at the moment. However, I'm going to contend that these missions cannot be fulfilled in any kind of serious way. You'll see how this comes about. That would be the kind of claim. But I'm first going to look at two technologies and two crises. The two technologies are the rise of kind of financial instruments, for example, derivatives, that have led to the 2007-2008 financial crisis. And is algorithmic, or some would call high-frequency trading, and this culminated in a 2010 flash crash. Now these two different technologies are also simultaneous. The algorithmic one, trading, basically deals with the trading of derivatives. So they're in a sense combined, but I would like to look at them in a kind of separate way at first. Okay, sorry, okay. But I want to go through a couple of basics. For some of you, these might be totally obvious. But I think it's important to understand what we're dealing with and what exactly is happening in terms of technology in the financial market space. So the question of derivatives. This is a technology that has developed in the early 1970s, and have grown exponentially in terms of market capitalization and the kind of just the sheer number of these products in the 2000s. So what exactly is a derivative? A derivative is a type of financial instrument which is entered into in connection with an underlying asset, index or reference point, which has a variable financial value, for example, a floating rate of interest, currency exchange rate, or commodity price. Derivatives involve the transfer of risk from one party to another. They can be used to limit a party's exposure to a variable or allow a party to gain exposure to this variable. There are, of course, many different types of entities that one can enter into derivatives, such as banks and other investment firms, governments, authorities, and supranational authorities. There are three basic types of derivatives. Options, these are contracts that allow one to buy or sell a given tradable asset at a set time in the future for a fixed price. There are forwards, non-standardized contracts between two parties to buy or sell an asset, and kind of underlying assets at a specified future time at a price agreed at the time of conclusion of the contract. And swaps, contracts that allow one to exchange one underlying stock for another under certain conditions. So here with contracts and a certain underlying asset. This could be oil and gas, but it can also be the prediction of weather. A kind of really strange and odd type of underlying. But basically, one is writing a contract to kind of predict a certain event in the future. Okay. So the majority of derivatives are entered into between two parties, one of whom is frequently a financial institution such as a bank, and these can be either traded over the counter, OTC, or through an exchange, exchange-traded derivatives. Now, the derivatives that are going to be a kind of a focus here are the over-the-counter ones. These derivatives are contracts that are privately negotiated and agreed between two parties. Traditionally, such derivative transactions have been largely unregulated and are not required to be reported to a central bank or financial regulator as a distinct transaction. Now, you could go to a bank and say, I'm willing to bet that the housing market is going to fail. Can you give me a contract for that? And can you give me some terms as to a payout? And if the housing market does fail, how much are you going to pay me out? If it doesn't fail, I'm going to pay you a fee. Basically, this is a kind of over-the-counter derivative. And now, because people were approaching financial institutions with all sorts of different contracts, there wasn't really anywhere that these were classified. So let's look at how this financial innovation, these kind of sets of financial innovations, culminated in a crisis. But before we do this, I need to introduce three more derivatives, kind of more specific derivatives that played a major role in this crisis. Of course, if you've been following the 2007-2008 financial crisis, you may have heard about these terms, but let me refresh your memory. So we have a contract called a mortgage-backed security. Now, this is a contract that was developed in the early 70s, and the idea here is that it's a security, a type of asset-backed security, which is secured by a mortgage or collection of mortgages. The mortgages are aggregated and sold to a group of individuals. This can be a government agencies or investment banks that securitize or package the loans together into a security that investors can buy. Sounds pretty obvious. Now, the mortgage-backed securities have been around since the 70s, but they've really started rising to prominence in the late 90s and the early 2000s, primarily because of the huge growth in new homes in the United States. But because home loans are rated at different levels, so people that have very secure income get a home loan, and there's a high probability that they're going to pay this home loan off in time, is mixed with people that don't have necessarily secure income and also take out home loans, but are not necessarily guaranteed to pay them off in time. So what was of interest here in the market was to develop a new product that was going to bundle all the not so good home loans into a security so that those could be sold. Because the good home loans, the good home loans and the kind of MBS instruments were already being sold in the market, but the kind of financial institutions had to come up with a product to kind of put to market those that weren't being necessarily sold. So they developed a thing called a collateralized debt obligation, a CDO. A CDO is a complex structured finance product that is backed by a pool of loans and other assets and sold to institutional investors. Now, these assets become the collateral if the loan defaults. These were developed in the late 80s and rose to prominence in the early 2000s. By the late 2000s, they constituted $1 trillion market capitalization. Now, they are complex because they are made up of layered tranches or slices of different loans rated from low risk to high risk all the way to junk. Now, by the mid-2000s, mortgage-backed securities accounted for more than half of the collateral in CDOs. What is important to remember here is that what we're dealing with are slices of different loans, not full loans. So you're kind of amalgamating different slices. And because the portfolio of these slices is being diversified, there's an argument to be made that they are going to be strong financial instruments that will deliver us some sort of return. Now, what was happening is that because these were being produced at an enormous rate, because they were highly profitable, all sorts of different loans were being put in, oftentimes really bad loans. But because we were dealing with slices, you were assuming that if there was one bad loan that was somehow, if there was one bad loan, it would be equalized by somewhat better loans in these slices as well, so as to kind of protect the investment return. Okay, but in the mid-2000s, a new financial product, because of course derivatives are just a set of contracts, a new financial product was developed, namely a credit default swap, which is a financial swap agreement that a seller of a CDS will compensate the buyer in the event of a debt default or other credit event. Now, because so many CDOs were being sold, some parties decided that the housing market could be shorted. In other words, that there was no guarantee that the housing market was going to keep growing. So they developed a new contract to bet against the housing market. And this was then the credit default swap. Okay. All right, so basically, in a few points, this is how the 2008 financial crisis unraveled. We're talking about a pure experiment in financial deregulation that spanned 30 to 40 years from the early 70s to the late 2000s. So from the 1990s, especially, people borrowed a lot of money. A massive bubble was created in the securities markets. Stock prices went up. We had the financial, the dot-com boom. Houses prices doubled. Banks gave out huge loans. People were encouraged to move money from savings to money markets. Accounting firms audited and found nothing wrong. Credit rating agencies all said all is good. All these loans and the packaging of these loans into kind of tranches into CDOs was being rated as profitable and good investments, because how could the housing market fail? However, what happened then is people started defaulting on their mortgages, banks collapsed, unemployment tripled, people lost savings. Regulators had done nothing because a third of them third of it had gone to work for the bank. Okay, so this is kind of the general story. Most of you have already known this if you've followed the financial crisis. Who and what was at fault? The general story from the financial crisis was that financiers, the greed of investment bankers, and regulatory failures, the massive market in unregulated financial instruments. Now, these were the kind of a two-pronged story: greed and regulatory failures, so human behavior and regulation of new products. Okay, so effectively two forms of regulation were introduced. The first, the reporting and registering of financial instruments. Now, in the EU and the US, in the EU, the European Market Infrastructure Regulation was adopted. In the US, the Dodd-Frank Wall Street Reform Consumer Protection Act of 2010 was also adopted, which means that certain parties were required to clear certain standardized OTC, over-the-counter derivatives, through central counterparties, and all OTC derivatives will be required to be reported to trade repositories. Now, here's the idea that to create a derivative, you have to report it and classify it somewhere at a trade repository, so everyone knows what kind of product you're dealing with. Apparently, this was supposed to solve the problem of the derivative, but as we'll see in a minute, this doesn't really approach the issue. Okay, but at least one could say that the large market of new financial instrument that was not regulated is now starting to be regulated by way of some sort of classification. The other aspect was this idea of regulation of human behavior. Now, of course, sociologists and anthropologists have written numerous studies about human behavior and traders and the kind of like the use of drugs and the stress and the adrenaline and visiting, you know, the kind of prostitution, this kind of frivolous lifestyle of a trader was examined in a number of ways. But I would like to look at a slightly new field that started coming out of these events, namely neurofinance. And the idea here was to combine at an intersection different disciplines, namely behavioral analysis, environmental economics, and computational neuroscience. Now, the premise of this discipline is to create in a kind of lab-like environment situations in which people can act as if they were in a marketplace. They would be given money, let's say fake money, and they were supposed to be faced with a number of events, and they were supposed to be tracked in terms of the kind of financial decisions that they make in these stressful situations. What these neurofinance scientists or neurofinanciers decided to do was to track the effect of decision making by looking at MRI imaging. So looking at the kind of activity in the brain to gauge what kind of decisions were made at what time, in what circumstances. Important here is to think of this a lab-like environment. So it was to replicate a market situation, because we don't have market crises apparently on a daily basis. So how are we going to do this? We had to replicate a situation. So let's say you're one of these subjects. You are given $100. You are faced with an event. Stock price is going up or down. And what are you going to do with your $100? Are you going to take a certain risk? Are you going to put all of them on a certain stock to go up or down? This is kind of in general terms. And of course, you know, you study the brain and see, in this particular instance, the decision maker was irrational or rational. They made a good or bad decision. The idea out of this is, if we can study the moment and the way that the brain, the activity of brain changes, we will then be able to regulate a certain decision maker's actual decisions. And we can stop them from making a certain call, because we will have kind of tracked their brain and said, this is the moment at which they're about to make a bad decision. So in a form, this is, in a way, this is a kind of form of human regulation. Okay. All right, let's move on. This was the first part of the story, this kind of derivatives, new financial instrument. What we see here is the New York Stock Exchange. This is generally the place where we think that financial trading is done. What we see here, when the image does eventually change. Yep. Okay, what we see here is the New York Stock Exchange. This is the new New York Stock Exchange. This is actually where trading is done. Most trading is done in this building here. The building has no windows. And while the old building had plenty of people, traders, sorry, these images are not changing quickly. While the old stock exchange had plenty of traders, the kind of general image that we see on TV and that we've kind of become accustomed to, what we've moved to is this. This is what happens inside the New York Stock Exchange, inside that building with no windows. This is what we would call a data center, a place that's filled with a range of computers, switches, converters, miles and miles of fiber optic cabling. Why is this important? Because this is a major innovation in the financial markets. But this innovation isn't necessarily new now. It has been going on for a while, for at least the last 40 years. Namely, there have been two revolutions in the financial markets. In the 1980s, there was a revolution in terms of a move from human-based to electronic quoting of stock prices. Now in the 2000s, we moved from a kind of human-based and electronic quoting to an algorithmic trading of stocks and shares. Now, what basically algorithmic trading does, or the situation we're in now, isn't a qualitatively different situation. It's just that we have now the technology to do the kind of work we had done by hand before. We can do it now on a computer. So we don't really need traders to stand and talk to each other and negotiate with each other on what stocks to buy and sell at what price. We can actually have this done by way of a computer. We can kind of talk by way of computer. Okay. So what has this move has basically forced us into a new space, into kind of new arms race, if we would like to call it that, namely kind of race to zero. What do you mean with the race to zero? I'll take two quotes here that will give us a sense of what's happening. 250 milliseconds, the time it takes for an information to reach a geostationary satellite, are hardly noticeable while talking, but it's long enough for a crowd to get ahead of you in the market. Now, the idea here in this kind of new environment is that because we're not dealing with people trading in a pit, we're dealing with computers speaking to each other, and especially that they're speaking to each other through an intermediary, namely an exchange. The idea was to get as close as possible to an exchange and have the fastest connection to an exchange. Hence this kind of growth of fiber optic cabling. Because the thing is, if you were to get closest to exchange, you could put an order into the exchange that would be made before your competitor. Now, if you get in an order before your competitor, you can get a certain price that is better than your competitor and make a kind of margin on this. Okay, so that was in basic terms the situation. What happened then in 2010? There was a flash crash. The heads of the Securities and Exchange Commission and Commodity Futures Trading Commission often point out that they are running an IT museum. Really, the IT museum part is really important here. A better measure of the inadequacy of the current melange of IT antiquities is that the SEC and CFTC report on the May 6th crash was released on September 30th, 2010, taking nearly 5 months to analyze the wildest ever 5 minutes of market data is unacceptable. CFTC Chair Gensler specifically blamed the delay on the enormous effort to collect and analyze data. What an enormous mess it is. Okay, so here is basically what happened on that day in May. Trading was going on normally on the New York Stock Exchange, and at some point in the afternoon, between 2:30 and 3, the stock prices started falling dramatically in a number of instances over a kind of 30-minute period. And a whole $1 trillion was wiped off the market. And no one really understood what had happened. In fact, it took them then 5 months to figure out what had happened. And it's still not entirely clear what had happened, but they just wanted to trace the kind of sequence of the different actions on the market. Now, of course, because so much was wiped out in such a short period of time, without a general understanding, this spurred a kind of discussion of kind of how we can protect ourselves from this. But really, we have to understand one primary thing here. What is an algorithm? First, before we kind of speak a little bit about regulation, we need to talk a little bit about what an algorithm is. Without giving you some sort of exact definition, let's think of kind of two ideas here from traders and software programmers in the financial space. The first one says, ultimately, an algorithm is to some extent an attempt to synthesize and automate the skill of a trader. Now, we had already seen that traders previously worked in pits in the New York Stock Exchange and Wall Street, but now this has moved to a place in New Jersey, and everything's filled with data centers and computers. Really, the idea here is that the algorithm is to do the trading and the communicating with other algorithms through an exchange. It's basically a kind of decision-making system. A salesman for a software company selling HFT, so high-frequency trading firms. We robotize events, you might say. These are the kind of ideas I want you to keep in mind. Okay, so the response to the flash crash in terms of regulation was to institute a circuit breaker. Now, because it was clear that there was no way of maintaining kind of market oversight in a kind of dynamic sense, because if it took a regulator 5 months to figure out 30 minutes of market action, you can't actually have some sort of human oversight over this, especially that it wasn't clear exactly what happened. So one way of regulating this sort of market is to institute a circuit breaker. Now, a circuit breaker is not necessarily a new measure, but it's a measure that it's now, let's say, implemented more, or it has sprung up to the forefront of our discussion of algorithmic and high-frequency trading. Namely, the circuit breaker is a kind of regulatory measure that is used to temporarily halt all trading on an exchange. Circuit breakers are in place to curb panic selling. They're used both in broad market indices, such as the S&P 500, as well as for individual securities. They exist in the US, but also in other countries. Now, circuit breakers function automatically by stopping trading when prices hit predefined levels. For example, the S&P 500, a circuit breaker may be triggered after a 7, 13, or 20% intraday move. Now, if for no reason the price goes up or down, goes down by these kind of percentage points, then the market will be stopped to figure out, or let's say to calm everyone's nerves, as if calming people's nerves was what had to be done. Because of course the question is, if we're dealing with algorithms now trading with each other, there are no nerves to calm. But this is in a sense the way to think of regulation. Okay. Okay, so now we have two stories. We have the first story of new financial instruments, namely derivatives, and the kind of regulatory kind of responses to that, namely this idea of controlling human behavior on the one hand, and classifying and reporting on the different products that were invented, developed, and sold in the marketplace. And the second story is this movement from kind of people-based market to an algorithmic-based market. So now everything is happening at a level that's, in a sense, beyond human comprehension. It's happened very fast, and it's happening electronically. But I would like to introduce 3 concepts that are going to be required to kind of think through these two stories in terms of regulation. The 3 concepts are the concept of flow, the concept of code, and the concept of axioms. Now, let's start with flow. Now, the flow can be, the concept of the flow can relate to money, but it can also relate to all sorts of other things. Let's say the flow of sewage. We have a flow of sewage, and now it is moving from one place to another, and it's controlled in certain ways. Pipes, sewage plants. Okay. Now we can think of the money supply as a flow as well. So the flow is a transmission of money that moves from one pole to another. So take, for example, your bank account, where flows can be incoming and outgoing. Let's think then of this idea of the code. A code is kind of reciprocally determined in relation to the flow. It is not something that is instituted externally. It is basically that which qualifies the flow. It is an inscription, a recording that qualifies this flow. It is predisposition. It is a predispositional characteristic and determinate, and it is evaluative in nature. So a code determines how best to regulate the flow. So your paycheck is an inscription of the flow of money into your account, and it determines in advance how much comes to you. Okay, we want to think here of the code in terms of kind of a genetic code. The code creates something of the flow, like a genetic code. It's not understood in advance. You can't look at a genetic code in advance and see what kind of human or what kind of organism is going to grow out of it, but it does qualify flow in a certain way. Okay, that's a pretty tricky concept. The last one is axiom. Axioms, a concept borrowed from set theory, is a quantitative discriminant. Now, it does not qualify flows, it quantifies flows, or basically it determines them quantitatively, and it thinks of flows entirely quantitatively. Okay, these seem kind of abstract right now. Let's think of them a little further. All right, so axioms deal directly with purely functional elements and relations whose nature is not specified and which are immediately realized in highly varied domains simultaneously. Codes, on the other hand, are relative to those domains and express specific relations between qualified elements that cannot be subsumed by higher formal unity, except by transcendence and an indirect fashion. So codes have specificity and contextuality. They're in a sense evaluative aspects. So what is good and what is bad. Axioms are indifferent to what they are applied to. They don't purport to evaluate anything. An example of an axiom would be that of unequal exchange, buying low and selling high. It doesn't matter what you're buying and what you're selling, as long as it is buying low and selling high. So buying low at a low price and selling high. It could be a car, it could be a t-shirt, it could be an over-the-counter derivative. That's irrelevant. Now, that's really important to note, that what we're dealing here with in terms of axioms is that what the axiom is regulating, it's indifferent to what it is regulating, as long as it is regulating. Codes, on the other hand, are evaluative in nature. So you can, a good derivative can be established by a certain trader. This has value, or a particular derivative doesn't have value. That would be an approach in terms of coding. Okay. Now, how does this play out in regulation? All right. So regulatory agencies deal primarily in coding because they're trying to determine a fair and orderly marketplace, as we saw with the ASIC and SEC mission statements. So regulators code, for example, by introducing a requirement to report new financial instruments, as we saw, introducing circuit breakers, so ways to control a certain flow, and, for example, setting trading hours. I mean, these are just 3 examples of codes, but they're 3 basic examples. So setting the trading hours from, let's say, 9 to 4 p.m. Okay, before I move on, let's think of how this is played out in the kind of algorithmic sense, especially in relation to the kind of idea of the trading hours. Now, before the markets would open at, say, 9 o'clock, traders would enter the pit and they would negotiate with each other, buying and selling different shares. Of course, what the algorithms did was effectively do the same type of work, but do it at a temporal scale that was beyond human comprehension. So things would happen so extremely fast that there wasn't really a sort of negotiation. It was just an exchange of signals between different algorithms in exchange, and effectively the decisions to buy or sell were being made at that level. So nothing particularly different was being made. It was just in a way moving towards a limit. Okay. However, and this is the most important part, however, the flows that regulators are trying to regulate operate solely on the basis of axioms. We said that the regulators do coding work. However, the flows that they're dealing with in the financial markets operate only on the basis of axioms because, in a sense, they are quantitative flows. Money capital is a quantitative flow. So what is important is that there is a flow. There is a flow of capital. A code determines this validity. So let's say the SEC establishes that there are certain derivatives that can be traded because they've been classified. And then there's just the act of pricing. So we have established what exactly is being priced, and now there's just pricing continues. So no one really cares what the derivative is, as long as it is priced. Now it can be a derivative for predicting the weather or a CDO, it doesn't matter. If it's going to short the housing market, that's fine, as long as it is priced. That's what's of interest here. So algorithms are then able to integrate. This is at the level of derivatives. At the level of algorithms, algorithms are able to integrate the conditions, the preconditions of a circuit breaker into their own code. So they can develop in such a way so as not to write a price that is going to somehow go outside of the percentage loss limits. So traders, in a sense, fulfill their regulatory obligations by reporting a financial instrument, but the regulator still has no way of regulating the market of the instrument itself. So once the market hits, once the instrument hits the marketplace and people are involved in pricing, the regulator can't actually say what the next price should be or what a good price should be. They can only just let the pricing process happen. So in this sense also, chronological time is rendered irrelevant as a regulatory measure because what counts really is sequence at this point. And this is what was established with regards to the algorithmic trading and the problem of trying to understand what had happened in those kind of 30 minutes of that flash crash. What was established is that there was a certain sequence in relation to the access to an exchange. So ordinality, which is ordinality in the sense is primary in the market. The order of access to the market, who is first, second, or third, or the order of magnitude, who has the highest or lowest price, who's quoting the highest or lowest price, gets, in a sense, access to the market ahead of somebody else. Sequence and ordinality prove the irreducibility of time here. So being ahead of someone else is a question of speed, and this happens beyond human apprehension or thought. This is really what's happening, and the kind of algorithmic trading has, in a sense, showed us what the issues are. It's really that the action on financial markets really has nothing to do with human understanding or human behavior, because it happens at a level that is beyond our apprehension. And this is really kind of important to note because it kind of evacuates a certain part of regulation that we've tried to move towards. All right, so here's the kind of summary of the kind of regulatory aspects. Derivatives. So regulation is done through classification, but by virtue of being contracts, derivatives write new rules and in this sense realize the market in general and new markets in particular. In the final instance, the writing of a regulation is itself integrated into the rule that realizes the market in a new way. Instead of limiting the execution of markets, regulation only promotes it elsewhere and differently. What is of course important here is that once a regulator says you can trade this derivative, what then happens is the actual pricing of the derivative, which is then really the kind of realization of the market. Now this part can't be regulated, and because there's no way of establishing the goodness or badness of a price, there can only be establishing that a price is high or low. And now, of course, you can establish that in advance because traders have to do this traders or algorithms have to do this in the process of trading. And we know that these can't be predicted in advance because if we would know them in advance, then there would be no trading itself and no pricing itself. Okay, the second thing. Algorithmic trading. So rule or code-based trading, where rules can be determined in advance, but differentiation is established at the level of speed and access to the exchange. Code is written in such a way as to establish advantage by way of order, but non-necessity of human actors because it happens beyond human consciousness. Okay? And the kind of third aspect here in relation, a little kind of word on neurofinance, regulation of behavior. Neurofinance attempts the regulation of behavior, but it doesn't, in a sense, take into account the contingency of forces that cannot be predicted in advance. When a human is involved in the marketplace, this can't be, in a sense, modeled in a lab because there is a certain contingency of the marketplace that can't be predicted in advance by definition. So the market in the final instance has nothing to do with human rationality or understanding. Okay. Just to come back to this idea that I started with, this idea of fairness and order, finally, what can be guaranteed in the final instance is order. That is the order of prices. This order cannot be simultaneous because pricing is ordinal in nature. One price has to come before another price in the market. This, however, is neither fair nor equal by definition and in principle. So in effect, the agencies that try and regulate markets, they can't assure or guarantee fairness or equal access to the exchange or to the market, because this, by definition, is not something that the market can do, because the market only operates by way of sequence. So in a sense, the market exists because of inequality. There has to be inequality because there has to be a firstness and a secondness, or a higher or lower price in play for there to even be a financial market. Okay, that's it.
Thank you so much, Nick, and thank you for taking the time to explain some of those concepts that I think not all of us would be 100% familiar with. So I think it was really helpful.